Campbell Soup. Adjusted quarterly profit coming in at 49 cents a share. That's 8 cents above estimates. Revenue was below Wall Street forecasts. Organic sales up 2% during the quarter. We do see a 5% pop in this stock. The stock's got more than a 3% dividend yield, too. It's interesting.
They're not the only one, name brand companies with yields like that. Why isn't that a good thing, Joe, in terms of support for some blue chip names? Why doesn't, with rates so low, why wouldn't people just buy those?
I think that's one of the biggest questions that we've had this entire recovery since 2009. You've seen outflows from equities pretty much since March of 2009, and you've seen a couple $1 trillion going to fixed income, and equities continue to be this under-owned asset class generally. You've got dividend yields now higher than 30-year treasuries. You've got decent fundamentals, and I think if we're entering a slowdown, the way the yield curve is telling us, you're going to want to be in defensive issues. A lot of these defensive stocks have very attractive dividend yields. I think equities are probably one of the safer places to park your cash if we do end up running into recession or something else.
But when you're talking about something like a Campbell Soup in consumer staples, this is a group that has had that benefit of being a defensive play. And so you're dealing with a PE for Campbell, let's say, of about 36. And that seems like that would take away some of the defensive-ness of a Campbell Soup.
Yeah, and I think that the thing you've got to remember is the combination of earnings and interest rates. And with interest rates so low, valuation should be higher. And so I think it's right that these PEs are high, but when you look at things like emerging market sovereign bonds now trading at negative yields, you've got to ask yourself, what is the right level of valuation? What's the appropriate valuation? I don't think anyone's going to be holding an emerging European sovereign bond to maturity that has a negative yield. I think they're all betting that rates will go more and more negative. Meanwhile, you've got this asset class, in equities where you've got the prospect of some growth, you've got defensive characteristics, and you've got much, more attractive yields.